Welcome back. A lot to unpack this week. Talking about fixed rate mortgages, where they're going to be headed, especially with the most recent data coming out of the US this week, what happened the previous week with the Bank of Canada, and where does that leave Canadians when it comes to their fixed rate mortgages on pre-approvals, and ultimately all these millions of mortgages that are going to be renewing over the next little while. What does all this mean for the housing market? Canadians are looking to get out there and buy. All those Canadians that could have been on the sidelines. What's happening right now? What are we noticing as this data continues to roll out? We'll unpack that and more. We welcome you back to the channel. It is Friday, Finance Fridays, and thanks again for stopping by. If you have not subscribed to the channel, we invite you to go ahead and do so. Don't forget to hit that notification bell, as well as leave your questions, thoughts in the comment section below. And we'll get to those questions as well as we read every single one of them. And don't forget, if you learned something in this video or think that this information can help someone, please feel free to share the video. We appreciate it. It definitely helps the YouTube algorithm. So let's get right into some of the conversation points. Last week, we heard from the Bank of Canada, who cut 0.25%. This is old news now. Obviously, bringing that policy rate down to 4.75. Didn't really move the needle, not making much of a change. I mean, case in point, we saw that in the 5-year Bank of Canada bond. That 5-year Bank of Canada bond is the barometer for fixed rate mortgages, car loans, so on and so forth. I mean, ultimately, there's other measurement tools, other types of bonds, but generally for the simplistic approach, it is the 5-year Bank of Canada bond. We saw that sort of fall off as the Bank of Canada cut, but then quickly rebounded back up. And that changed this week with the US Fed conversation around the possibility of reintroducing or restoking this conversation of potential rate cuts. Now, if you recall, at the beginning of the year, January, we were talking and listening to what the economist had to say, saying, hey, you know, we have 6 rate cuts maybe coming, 5 to 6 rate cuts. Well, I mean, we're already in June. We didn't even get one from the US. We just got one from Canada. We see other central banks cut as well. I mean, ultimately, the global situation when it comes to inflation, they're starting to see that it could be pulling back, easing over the next little while. But ultimately, what's happening in the US is going to be the major driving force on what happens right here at home in Canada, especially when it comes to fixed rate mortgages. So the US data ultimately showed that inflation was cooling slightly. Saw a rate of change sort of gradually pull back from where we've talked about higher inflation levels where they're starting to spike, which is really good news because it shows that inflation is coming back down. US, Canada have the same mandate, trying to bring inflation back down to 2%. Obviously, Canada's is pulling back a little faster as a result of many other factors. Some of those factors, just to really simplify it, we have a slightly higher unemployment rate. We definitely have not enough jobs being created for the amount of people, the immigration levels here in Canada. We have obviously higher shelter costs, rents, and we're definitely facing some growth concerns, especially when it comes to businesses, productivity here in Canada. Completely different story in the US, and this is where the US consumer has obviously fared better than the Canadian consumer. A lot of that has to do with the fact that the US, most Americans who had a mortgage locked in at super low rates for 30 years, meaning they're not as susceptible to rate changes as they are here in Canada, where our mortgages generally renew 1 to 5 years, right? So the rate of change, obviously all these renewals, we have talked about the renewal cliff. As millions of Canadians begin that renewal process, they're going to feel that payment shock. That means less money to inject back into the economy. And that is really starting to show its strength here in Canada, or sorry, its weakness, because we don't have the same growth. So why is this all important? I mean, ultimately, Canada, yes, has its own economy, our own monetary policy. We have our own mechanisms here in Canada. The Bank of Canada governor has clearly stated that. I think that's why. One of the major reasons why they cut ahead of the US is ultimately not because of the exchange and obviously because of the dollar. I mean, we understand all those mechanisms. You know, some Canadians believe that that was not a good idea to cut. Some Canadians are very happy to see this cut. But ultimately, I think the US is now redirected on course to cut by the end of 2024. But that conversation is around 1 or 2 rate cuts, possibly 1 or 2. We don't know yet. Ultimately, the data will drive that conversation. The data drives the discussion.
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective.
Just like here in Canada, if we see the inflation rates sort of pull back, we see unemployment rates tick up, we see the economic situation gets really bad. Well, the Bank of Canada has really stated that, hey, if they see all these preferred measures of core inflation come back, they will be open to cutting rates further, getting them from this restrictive territory. That is literally the conversation. And on that conversation, I really think it's important to really dissect this, because many Canadians, we get calls all the time. A couple things. One is that variable rate mortgages are what is impacted by the Bank of Canada, right? The policy rate. It doesn't move the needle for fixed rate mortgages right away. It might have a chance of changing the course of Canadian bonds, but generally when the Bank of Canada cuts, it doesn't mean that fixed rate mortgages lock in step fall with them. There are two different mechanisms that basically move the needle for these two different products. So that's where we talk about the US. Fixed rate mortgages, treasuries in the US, what's happening in the US economy. If this conversation around a cut sort of moves ahead and we start to get that possibility of a cut, well, that means fixed rate mortgages in the US could be dropping from their highs around 7 to 8%, maybe down 2%, who knows, right? But ultimately, if the mortgage rates in the US, if the economy sees a cut, that obviously has a direct impact on our 5-year Bank of Canada bond, and that could move the needle for fixed rate mortgages right here. Now, ultimately, the question is, well, when, how is this going to happen? Is this going to happen? I mean, this is really the million-dollar question. We have calls and questions all the time, especially after the Bank of Canada cut, around and if this fixed rate mortgage is going to move. And right now, most of the major banks have not moved their posted rate. They haven't really made that move just yet. They're really, I think, waiting to see if we can get this prolonged sustainability in the bond market and these prices and these yields. Ultimately, a lot to do with that. And if they start to see this gradual descent and we start to see some rebalancing, right, then I think at that point the major banks and all the banks will start to really cut their posted rates. Now, that's not to say that some banks have not moved the needle already. I mean, a lot of the broker-friendly banks, we're seeing those 5-year fixed rates well below 4.79%, for insured mortgages, these particular insurable products, switches and transfers. And then, some of these rates are being quoted a little bit off their actual posted rate. So there is a little bit of a conversation. I promise we will do a rate update, but right now the things are so volatile right now. So this is where it's very complicated. Some banks, most banks right now are looking at the bond market, right? They're pricing those mortgages on a few different components: the size of the mortgage, the duration, the term of that mortgage, the amortization of that mortgage, ultimately how far from the date they're submitting that application to the closing date. I mean, these are things that the banks are doing behind closed doors. So, I mean, ultimately, we've been seeing some really good discounts. Hopefully, we'll see additional discounts on some of these fixed rate mortgages, but they won't really pass through, at least in my opinion, until the banks start to pull back their fixed rate mortgages. And generally right now, being in June, this could be a really interesting question as we gauge right into the summer market, then obviously into the fall market. Will the banks turn on the taps and become a little bit more aggressive? I mean, ultimately, a lot of our Canadian banks are feeling some of these pressures as they have to put more money aside for these potential bad loans as delinquencies continue to, eke up a little bit. They're starting to, go up, but still historically low. And we're seeing obviously some pressures with car payments and loans and debt here in Canada. I mean, it goes without saying. But ultimately, we'll have to see how this plays out over the next little while. So I think right now for a lot of buyers, and this is a question we're getting, we've been doing a couple podcasts and interviews with some individuals talking about where we see the housing market, because we have our feet on the ground, right? Our boots are on the ground. Right now, I really don't see a huge amount of individuals coming back to the market. And that could be for multiple reasons. I'll share a few of them. Right now, I think Canadians learned a very valuable lesson around home prices. I mean, they haven't fallen too much. A lot of Canadians are hoping for home prices to pretty much collapse. But I mean, that's really not a good thing. I mean, yes, if you're looking to buy a home, sure. But the question is your job security. If we enter a recession, maybe you're not going to get impacted, but someone you directly know will absolutely get impacted, whether it be friends or family. If we see job unemployments tick up, it's going to be very challenging. Canadians might not be able to pay for the things that they need. And if the economy enters that, recession, we don't land a soft landing, meaning we, sort of escape the recession, well, then the Bank of Canada would have to really pull that lever. And as we mentioned, the Housing and Bank of Canada are two separate entities. The central bank doesn't really focus on housing.
When we published our April monetary policy report, we were expecting some modest increase in house prices. That was ahead of this decision. We did then, and we continue to point out housing as a risk to our inflation forecast. So it's something we're going to continue to watch. Ultimately, what we target is inflation. We don't target any particular measure in the housing market or an interest rate, but it's clear there is some pent-up demand in the housing market. We'll see how it goes.
Everything they do impacts housing, but they don't base their decisions on the housing market. So I just want to make that distinction. And then obviously Canadians are looking at saying, okay, well, home prices haven't come off. I mean, variable rate mortgages maybe moved a little bit with that 0.25%. Yes, they're potentially going to come back, but I think a lot of Canadians really want proof that the Bank of Canada is on this trajectory to sort of cut rates, whether it be slow and steady or all of a sudden or gradual, what happens in the US. I think that's an important measurement. I mean, for Canadians that are looking at fixed rate mortgages, track the bonds. I mean, it's very easy to see what's happening, but I don't see this huge influx coming back to the market right away. All these Canadians that are on the sidelines, as much as the Bank of Canada says there's a lot of pent up demand, I think there's going to be this gradual slow bleed into the housing market. I sure hope so. I hope people don't get this FOMO like we saw in previous markets, because that could obviously mean that other Canadians are going to be feeling that pressure. And affordability, the number one thing is literally Canadians making good money, just not able to save for a down payment in some of the hottest markets in Canada. So we have affordability concerns here in Canada for sure. But there is equally a lot of Canadians that make really good money, that really qualify. They have the support of a down payment, either from savings or from a gift or from family. So, I mean, ultimately, there's this pool of people that are qualified, those that are not. We'll see exactly how that plays out. I think it's really too soon to tell. I really don't think we're going to see a massive run up in people getting back into the market, at least not at these rates and not with these home prices. If we start to see wages maybe increase, rates start to come down a little bit, we'll balance things out. We'll get back to a steady market where you're able to put in an offer, you're able to put in a conditional period of financing, review, inspection, so on and so forth, which is what we want. It's really what you should be gunning for, but ultimately we'll see how things play out in the future. But what do you think is going to happen with fixed rate mortgage? Do you think we're going to see, as a result of what's happening in the US, fixed rates come down in the next couple of weeks? Or are we going to be in a higher fixed rate environment for longer? And what will that do to the housing market? Let us know your thoughts, comments in the comment section. Well, we'd love to hear from you. But we'll leave the video here, wishing everyone a wonderful Friday, and we'll see you all next week.